The stock market's been rallying for quite a while. If you really look at from the end of 2022 to this point, we've been on an up market. I'll take it. I'll let my stocks run. It's fun to see the balance of my portfolio go up and up. So, where do I invest next? Well, bonds is a pretty good idea to buy when nobody's looking, to buy when the values of bonds, or I should say the yields of bonds, look attractive. To invest in bonds, I think it's easier, simpler than investing in stocks. Bonds tend to be pretty simple in structure, but it's important to keep a few things in sight as you buy into bonds. One of them is, where are interest rates going? What are interest rates going to do over the next couple of years? Really keep that in mind as you invest in bonds. Bonds could be a nice way of having some of your assets, some of your capital in a lower risk option compared to stocks. Right now, stocks are going up and up. Now, as 2022 proved, stocks don't go up forever. At a certain point, we may see a pretty good correction, if not a crash. There may be a recession on the horizon. We're seeing employment data get worse. We're seeing the Federal Reserve get ready to get on a cycle of lowering interest rates. And they do that when the economy is slowing down. When that happens, maybe stocks will suffer. I don't think that's going to happen in the near term, maybe toward the end of 2024 and into 2025. So, again, bonds could be a nice way of earning a very low risk yield. It's going to be lower than the average on stocks, but it's also going to be far more stable. And who knows, it may even outperform stocks, especially if stocks go down. In 2022, it's easy to outperform the stock market because the S&P was down upwards of 25%. So that's an example of how bonds can really stand up tall on years like that. So what I wanted to do is just kind of go through what I'm doing. Right now, it's hard to buy stocks. A rising market. I hate chasing stock prices. I love seeing my stock values go up, but it's hard to buy additional shares when stock prices keep going up and up. So I am really shopping around for bonds, and I'm picking yields that really make sense for my portfolio of bonds. As I've mentioned on other videos, I have a bond portfolio and it really serves a purpose. The purpose is to generate the cash that I need for the next 5 years. Kind of put the next 5 years and kind of take care of that. No matter what happens, I've got 5 years of living expenses. And that's what my bond portfolio does. Now, each year that I don't need that money, I just put it right back into an investment. Most likely put it right back into bonds. But if I see that maybe there's a better alternative investment, then I'll go with that. So let's go through a thought pattern that I've executed today in looking at bonds. The 10-year bond or the 10-year treasury is probably the most cited bond available. And the reason for it is, like, mortgage rates are usually pegged on the US Treasury. And that just means that's kind of a point in the sand, or a line in the sand that stocks and bonds are compared to. And I'm going to start with that, just kind of show where interest rates have been and where I think interest rates are going to go. Over the last year, you've seen interest rates really go up and down. A year ago, they were really going up, and when interest rates go up, the values of bonds go down, and when interest rates go down, the opposite, the value of bonds go up. It's kind of a contrarian effect, and it also has the same effect on stocks. As you see interest rates go down, stocks go up because there's the borrowing rate for companies is lower. The discount rate when we use valuation methods is also better for companies. So over the last year, we've seen an up and down. It went up, down, and then it went up until the late spring. And now it's been going down. The whole talk around the Federal Reserve lowering interest rates is really causing the overall interest rate that you would yield on a 10-year treasury, that is a bond issued by the US government, is going down. Now, I want to zoom out a bit and go over the 5 year and kind of show you something. When we were dealing with the pandemic, the Federal Reserve said, hey, we're going to lower rates pretty much to zero. So if you were in a 10-year treasury, you were making no money, which was a really bad idea. You could have made a lot of money on the stock market. You could have made money in other investments, but I was not in bonds. I was like 100% out of bonds during this phase. So when you have super low yields, why invest in an investment and lock up your money? But over the course of time, the Federal Reserve just raised interest rates quite aggressively. They went from near zero on the US 10-year and raised it up to 5%. I think that really was dramatic. And this is where Silicon Valley Bank went bankrupt. This is where they had a lot of trouble because as interest rates go up, the value of bonds go down. And Silicon Valley Bank had a large amount of bonds that lost a lot of value. They had to restate the value of those bonds, and it freaked out the market. They thought, oh no, Silicon Valley Bank is going to go bankrupt. And they had to run on the bank, and that bank doesn't exist anymore. So that's what happened to Silicon Valley Bank. So I wanted to show that. And I also wanted to show that historically, back in the 80s, bonds outperformed stocks. It was crazy. Bonds are paying upwards of 15%, and stocks underperformed bonds for a long time. We had high inflation during those periods too. But ever since then, bonds have really been tamed. I should say the yields on bonds have been fairly low, the lowest point being in 2022. All right, so we got a rising stock market. It's great to see stocks just go up and up. Keep going, stock market. I'm in favor of seeing the value of my stocks go up. I'll just let them run. But now, where could I find good value? Something that I like about bonds is they have a variety of different terms. You can buy a bond that matures in a year and you get your money back because you're basically loaning money to the government, or you're loaning it to a corporation or to a municipality. And you're agreeing that, hey, I'm going to lend you the money for a year, 2 years, 3 years, 10 years, 20 years. And at the end of that period, they're going to give you back your principal. In the meantime, they're going to pay you an interest rate. They call it a coupon rate on a bond. So what's nice about bonds is that you can have different terms. You could also have different levels of risk. You can have loans from the US government. Now that's pretty good, unless the government ceases to exist here in the United States, which is highly unlikely. If we have a complete collapse of the US government, we've got plenty of other problems to deal with other than our money. So the US government, very low risk. And then we go down the ladder, I would say, of risk. You have AAA rated corporations, which are very low risk. Those are companies like Apple, Johnson & Johnson, and you go down to single A. And you have some corporates that are triple B. Now, I want to highlight triple B because a lot of these companies that are in this classification, these are companies I'm willing to invest in, and I'm willing to buy their shares. So why not buy their bonds, especially shorter term bonds? So I'm okay buying into triple B. I found better yields in that category, but I also mix in triple A's and US Treasuries because those tend to be super low risk. Might as well have a part of that in my overall bond portfolio. As I look at triple Bs, you can see that, the shorter terms, they're paying upwards of 5.5% on a 1 year, 6.5 on a 5 year, and it really jumps up nicely on the 10 year of 7.51%. Now that's pretty attractive. When I look in that category, I can see that there's a variety of companies that have that risk level. Now, some of these companies I've never heard of, and I never invest in something I don't understand and I'm unfamiliar with. So I'd rather go to companies that I'm very familiar with, like Ally Financial. I'm very familiar with. They do consumer lending, predominantly around automobile sales and financing. There's Goldman Sachs. I'm very familiar with Goldman. Citigroup, I actually own their shares, so I'm very familiar. And of course, I'm very familiar with Wells Fargo. So I think some of my analysis for stocks really benefits me as I look at bonds because I have a comfort level around some companies. Specifically, Citibank or Citigroup is really a company that I am very comfortable taking a look at. Now, when I look at Citigroup, I see that they have what would be the coupon rate is 5.75. That's specified on the bond. We're going to pay you this interest rate on this loan that Citigroup has formed with these investors. Now, the overall yield of this bond is 5.71%, the current yield. That just means that you're going to buy it close to the face value, and think of increments of $1,000. A bond typically is sold in an increment of $1,000. You're going to buy it near $1,000 to get that yield at around 5.75. If the yield was, let's say, much lower, like 2%, they would have to discount the price on that bond so that you can get a market rate, which would be around 5.75. But in this case here, it looks like this is a 10-year bond and a little less than 10 years, I guess 10 years minus 2 months. So this is a long-term commitment. As I buy bonds in this category, it really is, I have to drive the best terms for myself because I'm going to live with this for 10 years. So I actually put in a bid on these bonds because you could bid on these bonds. And I put a bid so I'll actually earn 6%. You can offer a price that drives the yield that you want. In this case here, I put a bid in this morning, and on my platform, I could put in a bid that lasts the whole day and see if there's a seller that's willing to sell me bonds at the price that I'm willing to bid. So I put in a bid so I can earn 6%. Since it's going to be a 10-year term, it has to be attractive to me. If it was a 1-year term, I only have to live with it for 1 year. Maybe I'm a little more flexible, but with a 10-year, I'm going to buy under conditions that I find attractive because I have to live with it for so long. So that's a stream of thought overall on bonds and how I go through and select a bond. Now, bonds are part of my overall investing plan for my family. And I have a majority of my net worth is tied up in real estate. And second is stocks. And that those two categories make up, I don't know, 80% of my net worth. And from there, I look at, a bond ladder to fill in my living expenses for the next 5 years. And that's what I've created here and I'm showing as a bond ladder. And what a bond ladder really means is that you have a maturity, a term expiring like every year for 5 years. It's a 5-year ladder. So I have bonds that expire this year, 2024. I only have a couple left, and I've had a list of them already mature. And I was given back this money that I lent out as well as the interest. And next year, 2025, I've got a string of bonds that will mature and that money will be returned. It's with the US government, Microsoft, Exxon, Boeing, companies like that. And then 2 years out, 3 years out, 4 years out. And then the fifth year, I'm filling in, so to speak. I've got probably about, I'm going to call it 70% of that year covered. I'm going to buy some more bonds and I'm going to try to buy them so that they mature toward the end of that year. So I have that year covered. And I have some bonds that are more longer term. The bond that I bought with the Mexican Petroleum Company has really done well. I'm actually achieving a really high rate of return, well above 12% per year, which is phenomenal. Part of it is that the coupon rate is 6.84, and I got it at a really good discount. So I'm glad that I bought that bond. It's been a really good winner. And that's an example of how bonds could just really achieve a good rate of return. And then from there, I've got some bonds 8 years out, 9 years out. I try not to go too long in the maturity timeline because who knows what's going to happen, 20 years from now. And I do know that, the next 5 years, I think stocks are going to do well. We're probably going to have a pretty good correction or crash in the next 5 years. It's just realistic to think that way. But it's good to have, part of my portfolio in a lower risk investment that is providing income because the outcome I'm searching for here is this is stability. This is stability for my family. This is stability in cash flows. And it really can help me manage the risk of stocks. And if stocks really aren't working in a particular year and they really crash like they did in 2022, my bond ladder looks really good on years like that. It'll save the day and give me the time to really stay in the market, ride it out, and then really get back to a really favorable upward trend, which is exactly where we're at now. We've had 2 consecutive years of just great returns on stocks, which is awesome. But bonds, they're almost like, to use an analogy of football, we pay attention to the quarterback and the receivers when they make fantastic catches, and maybe the running back, breaks a nice run for 30, 40 yards to score a touchdown. But the interior linemen are always forgotten how important they are. Without the interior line, the quarterback doesn't have time to throw the ball. The running back doesn't have good gaps and to run through and so forth. Well, bonds, I can consider as my interior linemen, not very sexy, not really exciting, but they really serve to keep my overall portfolio very stable, especially when stocks are not working and things are really crashing. They can provide a lot of cash flow for me to invest at the right times. So the bond category for me is an important one. If anything, I encourage all investors just to get familiar and educated on this investment class, especially as you get older. Bonds really serve a great purpose for the older investor like myself. And really, at any age, you can learn about bonds so that hey, that's what it could do for me. That's how it could serve my portfolio. And hopefully that's something of value for you. So that's my quick video on bonds. I like to do a bond video every month, every couple of months, just to revisit this topic. It is an important one. It's not the most exciting topic, I'm sure. I'm sure that there's some stocks out there like NVIDIA or BT, a tiny company recently that went up more than 20% on a day. That's really exciting. That's not bonds. They lack excitement, but they really give you great stability, which is what I'm looking for. So with that, I really appreciate you watching. Just remember, I'm an individual investor. I don't recommend you buy any of the investments I ever talk about. I'm just sharing with you what I'm doing in hopes that I'm just helping the investing community have one more data point, one more reference point that you could use on your independent decisions as you make good investments and continue to grow your wealth in your portfolio. I really appreciate you watching. Good luck investing in 2024.